bull market story. Everything AI is tech. Everything optimistic is tech. Everything that's being built and everything that's future oriented is tech. Okay. So the 21 period and the 50 period had offered some decent support. We had, I'll circle this in blue. Okay. Just above the 21 period, at the 21, at the 21, at the 21, at the 21, just shy of it, just shy of it. Also, several touches the 21, as well as that little close, but we're back above it. So the difference is the 50 period offering some really nice support, but it's only happened twice in the last like 6 months because we were below it and now we're above it. So 21 period, 1, 2, we'll say 3, 4, 5, 6, 7, 8 opportunities this year. Again, since the bottom was in, reflexive rally, 8 opportunities to get long off of pretty nice support at the 21 period moving average. The 50 days offered it twice, and this is on XLK. The 50 day is something that I personally I've been talking about this for weeks, and almost like I've been exhausted repeating myself because I was just in disbelief that the market is going to keep going this long and keep staying away from the 50-day moving average. And so when the market put in this inefficiency move, I was actually selling some calls and broken wing butterflies inside my daily profit plan. We took some of those as bonus trades, but I was not surprised to see the market finally corrected. Now, that correction was one of our deeper corrections that we've seen in the last also 5 or 6 months. That correction was over 4%. Okay. This is Qs, right? XLK. This corrected almost 8%. Look at that. 7.94 on tech. That's a big correction. We go to SPY. I believe it was over 4%. So here's my SPY on the daily. From the all-time high to that 50-day, we were at 4.18% correction. That is one of the deepest corrections we've seen, since we were actually in a sell zone. This would have been a 4+% correction back in mid-April. This would have been, obviously Liberation Day and all that drama was way more than 4% in a couple of, peak to trough of 20%. Let's go to QQQ, which is a bit more volatile, but also kind of equally as reflexive. So the Qs, I believe, were down over 5%. Here's all-time highs on Qs, down 5.97, maybe a slightly bit higher than that, maybe a bit higher than that. That's maybe right at 6%. I got 5.97. So about a 6% correction on the NASDAQ, just over 4% correction on the S&P. And here we are, kind of dancing in between. We're right in the middle. I don't think this is a bad thing. I really don't. Okay. In fact, one of my favorite strategies to trade right now is, and let me just get a sense of everyone that's in the room today. How many of you think that the markets are going to find a way to finish at fresh highs before the end of the year? They don't necessarily have to stay there, but do you think that we can actually get to highs again by the end of the year? We're not that far away. I think we're only 51 days away from December 31st. December 31st is 51 days to expiration. So type in higher in the chat. Type in high or higher in the chat if you think that we're going to be at fresh highs, or at least hitting fresh highs before the end of the year. Because I think we can. I think that this was a really good sign of tech bouncing hard, the 50-day period bouncing hard, and it didn't just bounce, but it was also covered with a lot of volume. So the underlines of this were pretty strong. It shows that there's some fundamentally strong support in the market. The volume supported it. The market breadth bounced back a little bit harder. RSP is equal weighted, and RSP is up again today. So we now have 2 pretty strong recovery days in RSP, which is equal weighted S&P. If you go to QQQE, which is equal weighted NASDAQ, this one also from a strong bounce on Friday last week up to some fresh highs today. It's not as great as the QQQ, which is actually green on green, right? We hit the 50-day. We went up on Friday to finish the afternoon, and we gapped up higher, and we're green on the day. So market cap, again, is like back into the swing of things, still being led by market cap. Let's take a look at our heat map today. Heat map today, we have 63.6% of stocks advancing. That's a pretty good broad market rally, led by big names. Led by NVIDIA, led by Tesla, led by Google. These are all good. I've actually taken a decent amount of premium trades on Tesla these last couple of weeks. Not that it was not that it was a bad trade. It's like Tesla actually held up pretty nicely. Tesla is at 444. I did buy some shares. I did cover some shares. I did hedge those shares, but I'm talking about what I've done with some of the positions that I have back in here to add some protection and also generate some additional income. So I did take a couple of trades last week. I posted these for Project Options Edge. Here are a couple of examples. Tesla. So I have shares. This is an in the money covered call that I continue to roll for income. I keep generating pretty good income here, like every month or so, every like 30 to 45 days, getting like $300 to $500 of income. I bought these back in like the two. I mean, my break even on Tesla is probably like in the low twos now. Let me double check that. Let's go. Break even. Okay. I'm just still looking through my trackers here. SPY, NVIDIA. Okay. Tesla. Okay. I'm just going to track my break evens here. So the one trade I put on was a kind of a ratio spread combination for over $1,000. I like that trade a lot. That would be all the way down to either a 220 assignment trade or a 250, which right now those assignment prices are pretty slim. I don't think those are going to get filled by, those are out to January. So I don't think Tesla's going to fall. I mean, we're at 98, 97% probability of profit. I've got 370 and 663. So over $1,000 of profit on these two trades. It's just a matter of waiting, 67 days. I'm hoping that price is going to stay resilient. It should, 97, 98% chance of profit. A 1111. This is a, hedge trade, $1,000 hedge with another, premium sell up to $300 income. I'm up over 50% on that trade right now, or just under 50% at 48.7. Ratio spread for over $600. This one's out to December of next year. This one's a modified collar. This is my covered call and some puts with the shares that I have. That one's up over $1,100. So I'm using Tesla for some pretty juicy premiums. I'm up 25K on this one account, and that's on a lot of my margin accounts, 2, 3, 4, 5. And some of these got added in later. These are at the top of my portal here. These are pretty new accounts within the last like 2 or 3 months. So kind of my core clients that have been with me for the last, 10 plus years, they've had these trades in with me since, early 2025, fall of 2024. These are all pretty fresh trades. And all those are showing, 20, 25% profit, or $20 to $25,000 profit, I should say. So that's good. So overall, that's good. Tesla's been a good one for some nice premium. Let me just check on something here. So we're at 68.19. I had a pin price at 11. I took it for an 1150 close. Right now it's traded for $11. I mean, it's offering a bit more profit. It's. I mean, I closed out the trades earlier. This was I didn't officially make this in order. I told traders this is my waterfall income. This would have been close to like my double up. Let me see if I had it highlighted here. I took these off. I had some profit traps in. Some profit traps in where I was trapping price in here. I was trapping price in here, and I was trapping price in here. So the net result, I made about $250 today. I took a loss, and a win, but my net result was small loss, nice win, and I grabbed $250. That's not bad. I obviously can wait until the close to try to make as much money this as possible, but there's also a trap that if it goes too high or too low, that trap is worth zero. So I was going to take the net profit and move on. And plus, I had over like $860 of risk, and that's usually a little bit higher than what I want for a double up trade, which is why I didn't make an official group trade. But I daily profit play. Anyone that got filled this morning for daily profit play had a nice winner. Prices essentially from the open has gone only about. I mean, it doesn't seem like a lot, but we've gone about 30 points from the open, but we are using a pretty low delta on the call side. So I believe from daily profit play this morning, traders were filled down here for the dollar credit that we put in. And then shortly after, traders would tell me in classes that they closed that thing for like 30 to 35 cents. I had a couple people that closed it out for a 50-cent winner. So you get in for a dollar, you exit for a 50-cent debit, grab a 50% return is pretty good for daily profit play. That's great, actually. Yep, there you go. So Larry says 140 out at 30 cents. Awesome, dude. That's a $1.10 winner. Nice. That's a great trade. Yep, good stuff. Okay, so I'll see where the day continues. I didn't get filled at the daily profit play like I wanted. I canceled the trade this morning because I was also skewed to the put side. I did a 10 delta call with a 15 delta put, and I didn't want to keep the skew, so I was either considering going 10 and 10, okay, or because the trade kind of opened up right here, we started to threaten. I put in butterfly spreads and iron flies instead to give myself a bit of a profit trap and reduce the risk, and that worked out okay. So anyway, all right, let's do a little top down today for Gamma Report. So Tesla is fine. Let's just go Mags. Okay, Mags is in between. You can see on a lot of tickers here, kind of the broader market stuff that I'm looking at. If we go to SPY, a really nice bounce off the 50-day moving average. And I've been talking about these levels for a while. So SPY testing support at the 50-day. Here's the NASDAQ, the QQQ hitting the 50-day. Here's the SPX and XSP hitting the 50-day. XSP is a little bit cleaner. Hitting the 50-day with some support and having some follow through. If you go to XLK, which is what I think is a really key level to keep this bull market going, XLK is going to want to see some love to the upside. If XLK is going to fill this gap or come down to retest this 50-day, it's going to drag the market with it because this is heavily weighted. If you go to sector stuff, take a look at XLK and see where the weighting is. XLK is heavily, heavily weighted in big tech. Take a look at your index weight. NVIDIA is over 14% of this. Apple is 12.7. Microsoft is 11. Broadcom, Palantir, which took a lot of volatility in Palantir, which is 3.6. AMD at 3.38. Oracle at 306. So, I mean, obviously the big weights here between Microsoft, Apple, and NVIDIA. What is that total market cap? So I should say 1467, 1273, and 11.8. Almost 40% of tech is weighted literally in NVIDIA and Apple and Microsoft. So any type of pullbacks in those will bring XLK lower. And yes, there's other ones to maybe make up for it, but I'm pretty sure that if NVIDIA, Apple, Microsoft are going down, they weigh enough, they're big enough. This is, it was a $5 trillion company. Now it's below that because of the recent pullback. But it's right there. I mean, NVIDIA is by far the largest company in the world, $4.8 trillion. Apple, one of the largest companies in the world. These are top three we're talking about here, 3.98 trillion on Apple. Microsoft, 3.75. I mean, Microsoft does look technically decent. If we hold this low, work our way back up, I think Microsoft looks good. Okay, I'm actually curious. I mean, maybe 340 or lower. Let me see something here. 340 or lower, Microsoft. I know it's a lot of risk. I may not take this trade, but I'm curious if I go out to the end of the year, just the 26th expiration. If I went to the 16th, that wouldn't be terrible, but December 16th, 26th. If I sold the naked put below the April lows at 345. That's what I thought. I mean, it's offering little to no premium. If I went out to January, which is a little bit further out, only 67 days, maybe it's a bit better, but not a ton. Yeah, this premium is still not great. So even going all the way out here to 340 something, I'm probably not going to get the trade that I want. I did generate a pretty decent amount of income on Microsoft. Lots of income trades, ratio spreads. We did a lot here for Project Options Edge, and those paid pretty well. I don't think I have anything left in the trade. I think I've taken all my profit on Microsoft this year for some of the income strategies. Microsoft is not here. Yep. So I took all the profit, which is good. Okay. I was just curious how that one was going to look. So like I said, possibly here where we have this low and this high, if you're looking for something somewhat cost effective, the market can kind of stabilize and head higher. Microsoft might not be a bad trade. Can we take it into the end of the year? The big earnings report is going to be in a couple weeks on NVIDIA. I mean, let me see something. I'm just curious going out to Microsoft, end of the year. Let's go out to this 26 expiration. Could I do a trade like so? Volatility is somewhat up, but not a ton. 200-day moving average around 480. Let me see what this looks like. if I did a 480, 475, 470, that's not a bad income trade, but let me see if I can hedge this. This isn't a bad trade. This isn't a bad trade. So I put in a little profit trap. It says 80% chance of profit. It's kind of flirting with the expected move. It definitely has some risk. I mean, if we look left on the chart, 470, 450, 455, and I'd be flirting with like potential risk around like the 470 area. So I don't take on any risk unless this is below 470. But I guess it's really like, do I like this enough to take the trade now? It's a $100 income trade. You know, it's going to cost me $900 in buying power. I make $100 on the trade. I also have a potential profit trap. This is not out that far. It's only out 46 days. If we have stability in the markets to finish out the year strong, then hopefully this looks pretty good. Let me do one thing. I'll do a little deep dive on Microsoft. So open this up. Let's check some fundamentals. Let's check this one for some breaking news. So Microsoft, Snowflake wise, Microsoft. I mean, Snowflake is good, below estimated values. Insider selling, we know. Price to earnings, 35 times, which a lot of the Mag 7s are. Fair value, 602. You know, compared to Oracle, compared to Apple even, Microsoft is not super cheap. Google and Meta, honestly, like of the Mag 7s, has some of the cheaper price to earnings, which I think makes them pretty darn attractive. Fair PE is 57 times. I mean, that's crazy to see that potential upside. So let me check one more thing on Microsoft. So outperform 650 to 625, 586, 680 to 682, 625, 640. All these are way below current prices. So I guess my question is, do I like the trade enough to either one, take the trade? Let me see what this looks like from a 111. 345, would I take the assignment? How far do we have to fall from all-time highs? What will be my risk? So I have a profit trap 470. I'd be assigned at 465 plus. I mean, it'd be like low 460s. So from current highs, 460, we'd be about 16+% lower. Oh boy, it's tempting. It is a good looking income trade. I don't know. I think it's a bit risky. I mean, I think I should tighten up the risk versus like taking on assignment. Obviously, if this thing turns, if it turns south, you know, I don't want to be stuck with an assignment at 460 that I can't really sell a lot of premium to get out of. I mean, if we have a fib retracement between the 50 and 61%, then I'm going to be in some trouble. So I think I'm just going to hold off. I'd rather use the April levels and sell some premium down here. Just the premiums are so low. I'm not going to get a lot of profit there. So anyway, all right. What else do you want to look at today? Let's use this. Let's use the time we have together for Gamma Report. If Kane comes in, great. If he's finishing up his webinar with JD, that's fine. But what else would you like to take a look at today? Okay, like I said, the big things for me is that XLK had a big pop off the 50-day moving average. The QQQ did as well. Equal weight is showing at least signs of life. If you look at the Dow or the Russell, the Dow also bouncing nicely in between the 2150 and to fresh highs today. The Russell, pretty big comeback. I mean, we had a big retracement or a big push on Friday where we got just below the October 10th candle and we closed above it. I think that's a really good tell for small caps to see that we're defending, that October 10th candle. And this might just go right back up to the highs. Okay. I think the market right now is like, okay, we're not necessarily going to roll over into a bear market. There was some news over the weekend that the government is possibly coming back online. I think there has to be some final votes in the House, I believe, in order for the government to come back online. I could see the markets doing something along these lines where, S&P is higher today. And because of that final test, it's like we're higher than the October 10th. We're higher than all these previous lows. We're putting in a decent low here at the 50-day. I kind of want to see how this area plays out. If we start to go no higher highs and not necessarily lower lows. My concern is that the market is waiting, right? The market is waiting and needing more confirmation to take us higher. So what is it waiting for? Is it waiting for the government to reopen? Is it waiting for inflation to show data? Waiting for job numbers to come in? All these things have been blackouts. But what is happening right now, what we have seen happening more and more, what the headlines are reading is layoffs are happening. I think there was a chart. I don't know if I pulled this screenshot. There was a chart that pasted something like 2020 and 2009. To be fair, it's not like we're just cutting jobs and they're not coming back. We essentially have as the Fed said, a low hire, low fire. But what we're seeing is 5 million layoffs for the month. And they're coming in all shapes and sizes in all different sectors. It's not just tech that's laying off people. Last week, I think American Airlines was a big announcement. Everything with TSA right now and government workers and people haven't been paid for over a month. None of this is good. So I'm not ignoring the potential risks out there. But I do think that whenever the government reopens, and I'm hoping it's going to be soon, I'm hoping that they also make good on back pay. I'm hoping that we continue to see SNAP benefits and no household should be affected adversely. I'd also think that with the government reopening, that's going to add some additional liquidity and kind of give the market a pulse once again. That's just constant flows. If you saw over the weekend, it possibly made some headline news today that President Trump was talking about a tariff dividend. And number one, I don't know if it's legal. I don't know if it's going to happen. I think it's speculation. I don't know if it's going to be a play where he can say this and say, hey, look, America's making all this money on tariffs. Let's go ahead and give it back to the people. And right in the time that the Supreme Court has to make a ruling, if the Supreme Court says, hey, look, what you did for tariffs is unconstitutional, you've got to figure out a way in 30, 60, 90 days to fix it. Then all of a sudden that tariff dividend goes away because the tariff revenue was supposed to be used to pay down government deficits. So if we're not doing that and we're just paying, households, I don't know. And I don't know how this is any better than what we did during 2020, 2021, which is 3 separate installments to households. And we ultimately faced a massive inflation wave and we're blamed that, you give people money and look what it does, right? Too much money chasing too few goods and we have higher inflation. So I don't know how it's a good thing. Obviously, it feels good to get a check if you're a qualified household, but if it just yields higher inflation, it's going to put the Fed in a tougher corner where they're going to see maybe inflation tick higher and they don't want to cut rates. And that's another thing that's going on in the background is, are they going to cut rates in December? So all these things are kind of up in the air, which is why I'm probably going to continue to hold off and, not necessarily deploy a ton of capital, but keep some dry powder. I'm sitting here just over 50% cash, which I'm pretty happy with. I raised a lot of capital the last couple of weeks, closed out a lot of winners, and I'll continue to do that and to kind of prune the portfolio, but I want to have some cash at the ready. And then strategies that I am deploying are going to be pretty cost effective and also give myself margin for error. Okay. Terry says, couldn't find the webinar link for waterfall income. I just took the one position today at 11:30, Terry. So were you in the 11:30 session or no? We did an 11:30 trade session, and then I just finished up a masterclass today from 1 p.m. to 2 p.m. So I'm going to have another masterclass tomorrow on waterfall income. So if you're in my waterfall income, we'll have a masterclass. We did a trade session today, took a live trade this morning, did a masterclass at 1 p.m. I'm going to do another masterclass tomorrow to finish up strategy 2. Oh, it says not a member. Okay. So tried to join but couldn't get the link. So if you jump into class, you're a member, then we'll have the trades. But the trades posted. The trade I took today is still totally valid. So if you're becoming a member, then you can jump into the trade tracker, see the trade that I posted. You can check today's session as well, whether it's a trade session and or masterclass, and review the trade that we did today. Okay. And then tomorrow I'll have another masterclass on strategy 2. Cool. All right. Couple things. I thought this would be fun. I do have to, let me do something here. So I'm working on a little something. Let me bring up this workspace. So income grid. I'm going to work on this guy. This is daily. I'm going to delete the daily. I'm going to go weekly. That's monthly, weekly. All right. So I can go weekly is on, hide this, hide this. Okay. So these are my weeklies. So what I am building here, this is just like a very rough version of it. I'm looking at building out a macro dashboard. Okay. So let me share some thoughts on this. A macro dashboard or a directional bias. Okay. To me, trading the market, so index related trading is about path of least resistance. Okay. So I get that technically and I get that fundamentally. So this year, fundamentally, we've had a pivot that was fundamentally bearish, risk off, systemic to switching to now fundamentally strong, bullish, optimistic, all in 1 year. That's a big spin of trading sentiment from go and this is why sentiment now is still so bad, yet the markets are sitting here at near all-time highs, right? And everyone thinks there's going to be a recession, there's going to be a bubble, the AI is coming for everyone's jobs, we have no hirings, blah blah blah. Like the markets can climb a wall of worry for so much longer than you think. Okay. And right now, the companies that lead the way, your NVIDIAs, your Apples, your Microsoft, your Teslas, your Mag 7, and whatever else participates in the tech trade and the AI trade. I think that tech and speculation needed to ventilate a little bit, which I think is what this last little correction was. You know, we had almost an 8% correction in the tech sector. We had a 4+% correction in the S&P, a 5+% correction in the NASDAQ, almost 6% correction. That was possibly enough to have a little bit of ventilation, right? Like deflate, maybe open the bottom of the balloon and let some air out before this thing pops into a bigger bubble that's going to burst. So anyway, fundamentally, things are still optimistic, and we're being led by some of the largest companies in the world. I do think that tech and AI and CapEx spending need to stay flush, and I think that they will. And in fact, and probably investors are not really going to know this until, I don't know, maybe Q1, Q2 of next year. If it really comes to like, hey, how much is Meta and Microsoft and Google and Apple and NVIDIA, how much are they spending every month? What percentage of sales are they spending to put into CapEx, to put into investing in AI and data centers and this build out and computing power? Also, technically, this is what I'm building out for all this stuff. I'm gonna do inside of my like one-click trading. I'm building something out where you can just have access to it. And technically, I've been a big believer that just simple technicals in the market. You've probably seen this before, but a 50-period moving average, okay, a 100-period moving average. I personally like the 144 and the 200. Okay. So technically, if we are price is greater than the 50 period and the 50 period is greater than the 144 and 200, that would be a bullish bias. You focus on buying dips. The market isn't technically derailing. You focus on staying in this melt up and positive drift. It's a bullish environment. If price is less than the 50 period and the 50 period is still greater than the 144 period, that to me is an indecision area. Okay. You can still proceed with caution, know that the market's still in a positive drift environment, but caution can be because if we don't turn up and resume the bullish bias, it doesn't take much for price to go from 50 period to then rolling over the 100, rolling through the 144, and potentially rolling lower into a correction. So that's either a indecision or stay out and wait. Okay. You don't have to wait very long. Honestly, I'm talking literally maybe waiting for like maybe 1 to 4 weeks at most, and then get a better decision on like path of least resistance. Okay. If price is less than the 50 period and the 50 period is also less than the 144 and the 50 period is less than the 200, then we're in a bearish bias. Okay. So bullish bias, I am buying the dip. This is proceeding with caution. caution or provide buffer slash margin for error in trades. I don't mind if we're in an indecision period. I don't mind selling puts. I don't mind creating trades that give me income with, my line in the sand is I don't want to see price going and invalidating all my technicals. So, trading accordingly where I can proceed with caution, still trade actively during an indecision period, but give myself some buffer and margin for error. I do that actually really well with waterfall strategy too. Okay. And then the bearish bias would be we are going to be selling. We can just sell. We can sell retracements, right? So we expect lower highs and lower lows. On the buy the dip, we expect higher lows and higher highs. Does that make sense? So this is something that I'm building. I'm hoping that I have the key to this for traders either at the end of the year or early in 2026, like very early 2026. This will be a lot of fun. And also it helps me make decisions and also build something around it. So I'm using this to also focus exclusively on trading the path of least resistance. So if we're in a bullish bias, we focus on trades to keep us in the game, participate in the market's ability to melt up and stay in positive drift, climb the wall of worry until things give us the technicals. Because I've said a lot this year, wow, I think we should have a pullback. I think we're going to have a pullback soon. Watch this 50-period moving average. Watch this overbought condition, blah, blah, blah. The market can stay overbought longer than you think, and the market can stay, elevated longer than you think. The bubbles can last longer than you think. The famous saying is John Maynard Keynes, the markets can remain irrational longer than traders remain solvent. Okay, Peter Lynch had a good saying that said that most traders, lose more money waiting for a correction than they would have if they just traded through it. I'm paraphrasing because I don't know exactly what it is, but it's something to the fact that most people that are waiting for corrections don't get it or don't get it to the degree that they want. And obviously right now it's so easy to see like how much negative news is out there, and yet we're still sitting here at all-time highs. Yes, I do not want to be a bag holder at all-time highs and watch the market drop, right? But we don't know if when the market is going to roll over, if it's a rollover of 4% like it was this last couple of weeks, or if it's a rollover of, 10, 20, 30%, like we're going to go into another deleveraging bear market like we did in 2022. I don't know. But right now, I go back to what I do know, and that is technically we are still in a bull market, and fundamentally, we are still riddled with optimism. Okay? What else could add fuel to the stock market rally? If the government comes back online, that has forced liquidity and flows back into the market. Back pay and people, getting made whole for the last 4+ weeks, that's money that goes back in the market. That's 401ks that start contributing again. If we do a tariff dividend and every household gets a $1,000 to $2,000 check, I would say 10 to 15% of that's going to find its way into the market somehow. Technically, we're still in a bull market. Fundamentally, there's things driving. U.S. and China, I continue to think will play nice. Obviously Trump disrupted that a little bit early March and April with the world, but right now it's like we're still doing deals. We're still negotiating. U.S. and China are still figuring it out kind of as they go, like month by month or quarter by quarter. I think that, we need them, they need us. And there's arguments both ways. Some say that China's way better prepared for this than we are. Some say the opposite. I don't know. But that's also, my job is I'm not on these negotiating calls with Donald Trump and Scott Bessent. So my job is to use what clues I have, which is charts and price action tell us a lot. Volume and money flows tell us a lot. Fundamentally, we have to give the market the bias that it has given us for so long. It's so good at being bullish, right? The market is so good at being bullish. It's so good at ignoring a lot of bad things to continue to roll up, right? Or melt up. That's positive drift. The reality is if we roll over and we have a nasty, nasty bear market, yeah, it'll suck for a lot of, it'll suck for everyone that's heavily leveraged for sure. It'll be annoying and frustrating to the traders that are ill-prepared, but I'll be fine. And if you're in my services, we'll be fine. Daily profit play, it doesn't matter. We are literally tackling the market day to day to try to win the day. Waterfall income, we're doing index-based swing trades, and we have lots of buffer. We have room for error, and we're also not taking tons and tons of risk where, we recognize like, hey, I've got 5 open positions. Let's take some profit. We got 10 open positions. Let's take some profit. Newsbreakers. It's a binary trade, black and white. Double ups, day to day. We're taking pretty much 0 to 1 day expirations. Pinch point, doesn't matter what direction we go, volatility is going to take us up or down. Okay, crash insurance, We just put a trade on last week for crash insurance. I paid $465 for a trade that offers over $5,000 profit. That's not a ton, but it's okay. It was like 11-1 or 12-1 when I took the trade. So if I need it, it's there. Project Options Edge, we've closed a lot of profit this year, and we've got like 95 to 99% probability of profit in a lot of the trades that we're in. So point is, we're going to figure out a way to navigate and survive it. If you are here to trade, okay, my question is if the market is going to drop, this question for all you answer in the chat, I'm curious what you tell me here. If the market is going to drop, okay, if the market's going to drop, if the market drops 10, 15, 20%, what is that going to do to your positions? That's the question that you should be able to answer at any time, because we don't know if there's another, Liberation Day type drama move. We don't know if there's a COVID type move. We don't know. So that's the weird, uncomfortable outlier that nobody really knows. But I think we'll see it. And as long as we're not totally exposed or overexposed or over leveraged, we should be able to trade through whatever the market throws at us. Okay. So I want to make this macro dashboard for me as simple as possible, because once I have my dashboard give me the path of least resistance, I'm not going to stack up lots and lots of trades. I'm going to look at maybe 2 to 4 trades maximum and trade something like this. Okay. So if we're in the path of least resistance, I'm only going to focus on this area buying. I can focus at the money and I can focus on this grid. So I will choose what levels I think are the safest. And to me, it's going to be either an at the money and then a 1 and 2 and 3 retracement. So either I want to trade and participate with the market's ability to go up, or like, you know what? I'll let the market go sideways, fall a little bit, and try to take an entry on some pullback levels and see if those work out. That makes sense? So if I take this grid, let me just kind of box this in for a second, just give you a visual here. If I take this grid and we're in a bullish market, I'm going to take this box, and every single week we can approach the markets every week, and we have this grid, 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 and we have this grid. And most of the time, what you're going to see is the grid is going to provide some padding, some support, and some profit. Yes or no? Yes. So in a bull market, path of least resistance is we stay with the direction of the trend. Yes, there are pullbacks, but the market likes to find its way back to all-time highs again. This recent all-time high we had back in October, this is October 29th. That was, I believe, our 35th or 36th all-time high for the year, which puts us up there like maybe top 15, top 20 of any year given all-time highs. And what's kind of impressive is when the market is at all-time highs, it's just a little bit easier when you're at all-time highs to just keep nudging higher. It's like the gas pedal is down and it's steady and it's on cruise control. And right now you're on a pretty safe highway where there's not a lot of disruption. So, this little correction, like I said, I think that there was a little air let out of this bubble concern, but the market clearly provided some strong technical support to, I think, reassure some investors and traders and technicians that there's some pretty good buying power here going on with the technical levels. All right. So watch XLK, watch SXP or SPX, SPY, QQQ. And like I asked earlier, how many of you think it's going to go higher? A lot of people said higher, higher, higher. I wouldn't be surprised. I wouldn't be surprised if we go higher. Is it going to be instantly? I don't know. From this high to this low, does the market, kind of stall in here? Like, yeah, maybe we could have some sideways, right? Sideways is a decision for the market. The market can go up, the market can go down, the market can go sideways. It is a behavior that we have to navigate, right? So our job is to figure it out. So if technically the market isn't breaking down, we can't keep staring at this market thinking it's going to go down. It's going to go down. It's got to go down. We have no idea. I wish I knew, but I can say this. If I'm going to show this market going down, it's got to take out this low now, and it's got to take out this low. If it doesn't take out either of these two lows, you are just asking for something that right now is low probability, and you're looking at the Cape Shiller, you're looking at valuations, I get it. Everything right now that we know, it's like, history doesn't repeat, it rhymes, but there's rhymes. I get it that we're overvalued, but I also think that this isn't a lot like the dot-com bubble, because the companies that are leading the way do have a lot of money. So until investors think that, look, Nvidia is spending way too much money on capex spend, or spending too much on this AI build out, or all these companies, it's like they're not doing it with debt. That's the difference. They have money, they have cash, and they're doing it with percentage of sales. Google has a crazy revenue stream. Amazon has a crazy revenue stream. Apple has crazy cash flow. Microsoft has lots of cash flow, right? NVIDIA's margin's like 80%. So they have cash. And yeah, if it turns out to be like they're spending too much of that cash and not getting the return that investors want, then you'll see the Mag 7 slow down, but it's not necessarily going to be, the bubble of all bubbles. I think what I'm more concerned with is that, this is what I've been saying a lot all year, is I think the biggest concern is that this market tries to go higher and will not stop going up. I think that is maybe the hardest risk for traders to deal with right now, because everyone thinks that this is the top. Your job of calling tops is nearly impossible. Okay? Because everyone that calls the top, you don't really know how accurate they are. Because most people say this is a bubble, and then they don't give you a time, they don't give you a direction, they don't give you a destination, and they just say in maybe a year or two or three, they're like, I told you it was. But you can spend years waiting. Okay? I'm not calling the top. I will say this market can probably continue to surprise us to the upside. And what I'm concerned with is that we literally go into like the everything bubble, which is we go so ridiculously high and everyone is super excited, but do not be left as a bag holder when this thing does eventually deleverage itself, because there will be a natural reversion. There will be. And, Buffett is not wrong. The Berkshire Hathaway, let's see if we can get a Berkshire B here. Okay, look at this thing. So Berkshire, again, looking a little bit off and iffy, but structure-wise from 455 up here, it's consolidating. But to me, this looks like a good trade where if Berkshire breaks north, we're probably going back to all-time highs. Okay, could it be choppy in here? Of course, all this could be choppy. But this would be more of like a defensive play because Buffett and company are sitting on tons of cash. You go to the Buffett indicator valuation model where it's total stock market value over GDP, it's like 2+ standard deviations higher, right? But that's why everyone's saying like, is it different this time? I don't know. This goes back to, it looks like June of 2025. We're 4 months removed from that, 5 months removed from that. But I get it. We're overvalued. Buffett and Berkshire has been a net seller of stock since 2024, but the market's sitting at all-time highs. There have been plenty of gains and opportunities this year. But I think cash is not a bad place to be as long as that cash is being utilized in some capacity. My unallocated cash, I do have it in bill or in SGov or in some type of like treasury, just so I can get some yield on it in the next like 30 to 60 days while I maybe need it for liquidity later. And I can be made whole and then get back in the markets where I want. That makes sense? So, like I said, I think it's silly to call the top. I was genuinely getting a little bit more nervous as things were kind of rolling over and there was like little to no data to go with. And, this hiring situation is bad. I just attended a 3-day AI workshop. I'm doing a 30-day boot camp. I'm going to try my hand and try to figure out how I can also like stay current, stay relevant, make myself more productive and leverage what my skill set is, whatever that looks like, whether I pick up a, little side hustle project or do something for friends and family. But I want to be in the know with like all these tools that are being made readily available and also being made cheaper to the masses. That's one thing that is kind of cool. Like all of the tech stuff happening right now is deflationary. Like the cost per token, I think is what the technical phrase is. The cost per token is like, we're seeing like a 90+% decrease in the cost of large language models, which for us is why we have a Chat GPT and we have Grok and we have Claude and we have Perplexity and we have, Copilot and all these other things. They're all getting cheaper and at our fingertips. So I think that's a good thing. And obviously companies are running with that in a big way. I do wonder if this is going to help like small and mid caps. Large caps are doing the spending, but does it benefit the small and mid caps by, again, potentially doing more with less? I don't know if they're going to necessarily fire everybody. I hope that they don't. But I would like to think that maybe they can just maintain, but just go on like a hiring freeze. We don't need to hire more people because we can do more with less. I feel much happier with that as the job outlook than everyone is now like on the chopping block. If you are, white collar paralegal, white collar admin, executive assistant, whatever, those jobs are at risk. You've got companies that are forming that are saying, we'll do this task for you. We'll build this AI, agents, and we'll do these things for you. And you can save lots of money and you can, trim your workforce. I don't like that as much. So I'm hoping there is some compromise or some happy medium where it's not just AI is that disruptive, where it's just leaving us all to fend for ourselves. Right. So anyway, all right. I've been doing a lot of talking. What do you think? Thoughts, questions? What do you want to see? We can do some top down. Like I said, I'm watching SPX and SPY very closely, NASDAQ very closely, Tech, XLK very closely, watching gold and silver very closely. The dollar's pulled back a little bit here. Dollar's pulled back for a couple of days. We're right at some key daily technical resistance. I do want to keep a close eye on the dollar because if the dollar continues to march higher, that is still going to be risk off trading, in my opinion, for the equities market. If the dollar retreats a little bit lower, then we still have some risk appetite left. Oil, pretty stable around $60. I think I'm not saying the floor is in. I mentioned this in the last couple of weeks. I'm looking at this from a big picture. I am planning on a pretty big oil trade. It's not going to be all in. It's going to be dollar cost averaging, but essentially going long oil now, long natural gas now, and probably holding this through like 2028, 2029, 2030. I think this is a portfolio allocation. I think that energy needs, computing power needs are off the charts. We have demand right now that is it's essentially insatiable. We can't fill enough computing power right now, but we need the energy. So whether that's oil, whether that's natural gas, whether that's whatever energy we can throw at this AI stuff, we need all of it. But I also think that this might be, in terms of inflation pressure, I don't think that the U.S. wants to see oil prices spike up to $70, $75. So I think that keeping oil suppressed, maybe even pushing oil down into the 50s again, maybe into the 40s again, I think that is possibly short-lived until it becomes unprofitable for a lot of companies and countries. And then you buy oil when it's at, 50, 45, and 40. And that, I think upside-wise, even minimum, we have like a $65 target. We could surprise ourselves with like back to $80, $90 a barrel. I'd be really curious to see what this looks like in the next few years. But from here, it's like I am going to position for long oil at 55 and 45 and even 35, willing to put in a percentage allocation on oil. Okay. All right. Natural gas, we're at $14. This would be one that I don't think I'm going to hold it that long, but I do have a long call on natural gas out to 2027. If this can somehow give me a nice little squeeze trade, even if it's a range, I'd love to see some natural gas come back up to like $22. So I bought the $5 call and I've been selling calls against it to lower my debit. If we get up into like $21, $22, my break even is around like 13. So I'm trying to make like $9 or $10 for the spread whenever it's done. It's going to be, I'm buying this to 2027. And if I can sell near term against it up here, I'd sell like almost an at the money or in the money for like a 30-day expiration. But if I get this right, where we just have like a push up to, $22, $23, I'm just going to close this. I don't really want to hang on to this thing, but I do want to get some profit out of it. Hopefully it's there. Gold and silver. These have been big on the list for a while. Gold's having a nice day today. We're back above the 21 period. I did scoop up some dips. I did this. This is a project options edge trade. I did a CEF and PHYS. Those both got filled for some dollar cost averaging on gold and silver. That's it though. I think I had 3 to 4 positions in on each one of those tickers. I only got filled on one. So I got filled on one chunk of CEF. I got filled on one chunk of PHYS. I still have gold positions running and so GLD and SLV running. But anyway, I mean, gold is up. We're back above the 21. I'm curious what this does. Is this a high, low, lower, high, lower, low? Maybe. Is this a high, low, range, stay here, moving averages catch up, and we just find support and go higher? It might be another accumulation. I would hope it's actually corrective. After being a 2 to 3 year bull market, I'd hope this actually is corrective. Part of me wants it to be corrective. All right, let me check one thing. I've got some trades running on SPX that are pending. I'm going to see if those get filled. I don't think they're going to, but let me check. Working. So filled. Call side, I have the 65s. I don't think that's going to get filled. Could we make it to 68.50 today? That's an impressive run. You look at the gap open today, which is like 0.9%. Market gapped up around 0.93, pulled back a little bit. Market's up 1.56%. I talked about this technically. Okay, let me extend this line out. Let's go settings. There. So if you look at the resistance, resistance, I mean, we're back above it. One thing I'd watch for this week is if we pull back and test today's intraday low or test the backside of this trend line. If this holds, off we go. If it's positive gamma, it just keeps drifting higher. This market might not give a crap and just go right to all-time highs again. So we'll know this day to day in daily profit. You come to my daily profit sessions. We will attack this day to day. We watch these levels all morning. You know, we said we were going to be in positive gamma at the open today, and positive gamma persists. So right now the markets are selling calls and selling puts, keeping this thing in the the slow grind higher. Market's up over 40 points from the open. So market makers even let Monday drift, which is kind of surprising. So I'm curious how the day closes. All right, let's go back to gold and silver. I haven't seen a comment in a second. Who's out there watching? Am I like talking to myself here? Let me know. Gold, like I said, I'm going to keep an eye on it. I'm long gold, PHYS, CEF, GLD. I'm long. Dollar cost averaging right now. I've been in gold for the last 3 years. I took a ton of profit this year on gold as we hit these crazy bubble levels. Not bubble, but don't be surprised. I'm just going to throw this out there. This is why I was, I was bullish on gold. We hit some crazy bar counts. We're still in a 500 plus bar count on gold. So I don't think gold goes too much higher without having a pullback to the 200-day moving average. So like I said, I see this playing out a couple ways. Either this is a high, low, lower, low, and we find this correction area and we can scoop up some more discounted gold for the medium to long term, or we're going to see another accumulation cycle here where this is going to be building and building and all these moving averages catch up. And this might just come and touch our 200-day, and then it's off to the races, and this is medium term. There's some pretty wild projections out there talking like 10K gold in the next couple of years. There's some wild projections on silver talking about $150 to $200 silver. I mean, you can make whatever crap up. It's like saying, yep, Bitcoin's going to $1 million. You can say it. It might happen. It might not. Nobody knows. I like the trade. If that's the opportunity, then I think there's asymmetry in gold. I think there's asymmetry in silver. I think you trade with proper risk management. Anywhere between 10, 15, 20, 30% pullbacks, stay bullish on them. I am willing to buy the dip. I think both of them are looking very attractive. I think from the scarcity standpoint, the physical standpoint, I don't know. I mean, you can call it inflation, but I mean, gold's had one of the best couple of years that we've seen ever. And, it's what's interesting is the retail side, right? The retail side didn't really start buying gold until it was like already at these crazy highs. So I wonder if like the retail crowd was so late and so leveraged that when this dipped, they're out again. Like they're not jumping back in. So to me, this is just like the steady bid of governments and central banks that are just going to keep gold prices bullish. Maybe. So I don't know. I think gold and silver is good on the portfolio. I like them both. Silver also off the lows, pretty nice. I mean, this low to high rally so far, to over 10%. Wow. So this thing dropped like 16%. Dropped 16% and has rallied 10 off those lows. That's not nothing. Let me take a look here at some of my exposure. So like I said, I did get filled. This is good. Got my project options as oil trade up about 80% of our profit. We got a 220 profit as long as we stay above $50. Plus there's a $500 profit trap in there. Futures trades are still, those are hedges. Those are going to pay garbage because they're hedges, and apparently right now I don't need them. I'm going to CEF, so some dollar cost averaging. I just got out of these trades. I'm up, $11,000 in the last. I don't even know when I opened this trade up. Maybe 2 to 3 weeks ago. I put one chunk into my portfolio to buy some gold and silver. This is a physical gold and silver trust. It's up 11K. GLD. I took a lot of my profits on GLD, but I still have some exposure, a couple of ratio spreads. Up nothing crazy, 169. SLV. Let me go PHYS actually. PHYS. This is more gold. This one's up almost $8,000. I mean, I just took like almost 150K in gold and silver, and now it's up another 20 grand. Like, that's good. And I'm not even done with the corrections. Like, I kind of want them to pull back more. Because I'm just kind of getting started on allocation, but we'll see. I'm hoping that I'm at least getting a big enough stake where I'm liking the overall positions. SLV, I'm a little bit heavier in. I did trim a lot of profit. I'm still up 100 grand, 100 grand on silver. I still own some shares. I'm still letting it run. But I'm also in a, collar trade. I'm in some income trades. I'm doing some bull call spreads that are asymmetrical, blah, blah. So it's kind of creative stuff going on here, but I have exposure. I think they're important. I think they're important to have in the portfolio for the next 2, 3, 5 years, maybe forever. There's arguments that if you put gold in your portfolio instead of doing the last, I'm thinking the 60-40 portfolio, by the way, everyone's heard of that. Like, you've got 60% equities and 40% bonds. That is, I think it's being proven to be less and less effective. So I did an interesting look back, and if you just replaced all of your bond exposure with gold for the last 40 years, you have like doubled the portfolio. So the 60-40, and this is crazy stuff. I don't recall the exact number, but if you are 100% invested in the S&P versus doing a 60-40 portfolio, let me look the definition up. Definition of Sharpe ratio. Okay, in trading, the Sharpe ratio is really important. If you want to see like what type of reward and risk can we expect, the Sharpe ratio compares investment's return with its risk. Okay, so risk-free rate of return right now is around like 3 to 4%. And you could argue like there's no such thing as a risk-free return. Yes, it'd be bonds. That'd be like the safest asset where it's guaranteed by the faith and credit of the United States. But that's in question whether or not that ever happens. I don't think you can bet against the U.S. But right now you have like a 3 to 4% risk-free rate of return. So what I thought was crazy was the numbers. You have return on portfolio, risk-free rate, and then the deviation. Sharpe ratios are always something if you're evaluating a strategy, is what's the Sharpe ratio. Okay, so here's what I thought was crazy. I think it was a 40-year window. A 40-year window. Let me see. I might have written this down. I think I texted this to myself because I heard this on a macro session. Give me 1 second here. Let me try to find this. It was pretty staggering. Okay. So I think it was since 1980 something. So about 40 years. The Sharpe ratio for the S&P is like 0.3. And the S&P for the 60-40 portfolio is 0.35. So what this means is if you're fully invested in stocks, you're actually getting a lesser return than if you had a blend. So diversification is important. Okay, now 0.3 is nothing to get excited about. In fact, that just means there is a lot of risk to generate basically a nothing burger return. Okay, so the argument is instead of taking your 40% bond allocation, is you'd put it into gold. Let's just say gold. I like the mix of gold, silver, and Bitcoin. Personally, I think that's more of like the modern portfolio. I think Bitcoin, to me, has a lot of asymmetry. I'm hoping that there's you want to trade this AI stuff. I think Bitcoin's a pretty pure AI trade. I think the adoption, the scarcity, the purpose of it, hopefully it's a good thing. I don't like what's happening right now with Bitcoin with like, if you've seen Strike, whatever MicroStrategy is doing with some of these financial injury products, which is you get like an 8% yield. It's almost like a yield max instrument. I don't love it because it is basically suppressing volatility and it's just extracting premium. But it's what market makers do. It's like if the market is here and you can sell puts and sell calls and the market stays in between, maybe Bitcoin is that. It's just less volatile now. I do wonder if we actually have like another, big rally coming at some point, but we'll see. Anyway, point is, if you took the bond portion out of the portfolio and put it in gold, you'd essentially double the returns over a 40-year period, which is not bad, obviously. The market's been pretty resilient a lot the last 20 plus years. Hey, man. Yeah. So I just think you can't just be all stocks. You can't be all stocks. You're going to live and die with the sentiment. You're going to live and die with the ebbs and flows. You're going to live and die with the bubbles and bursts. And none of that's going to be fun if you're 100% invested. So dry powder, manage your risk, having capital to buy on dips and get really good discounts. Who made the most money over the last 25 years? Who made the most money? If you look at the S&P on the weekly time frame, I know my charts are a little ugly here, but go back to, the dot-com bubble, right? Here's 08, here's 01. Who made the most money? Is it everyone that was, buying the highs and then that's it? You buy once and you let it go? Or was it the people that you can continue to add more assets? You can add more assets, you can just buy. You have like the ability to leverage and still have dry powder, still have cash. And obviously when the market is down, 50 plus percent, 50 plus, nobody wants to see that again. But if it ever happens, the ability to make generational wealth is you got to have dry powder to buy the dips, right? You're talking, historically significant dips during the dot-com bubble, again in the great financial crisis. And then after that, it was just little ebbs and flows of this is not nothing. This is like a 15 to 20% pullback in 2015, 16. You had the volatility from 2018 to 2020. It just like modern markets just continue to go, way higher to the upside, and then they need ventilation. Way higher to the upside, they need ventilation. Even though I've got a bunch of crap on my chart, I'm hoping you can see this as clear as I do. This is going to give us major support, which was literally the bottom in April. So any big ventilation that we have, if you can see this low, this low, this low, whatever happens here, this market should not want to go too much lower than like 6,000 or 5,500 as I'm talking about the structure now. If we break this level, this is the scary part. This outer trend line is way the heck down here. And all this funny money that came in through COVID is now going to like leave the system if it ever happens. But if there's money still flowing, you got the zombie market still putting flows in, everyone's still participating in 401ks, there's forced buyers in the market, there's buybacks, there's cash, there's liquidity. Path of least resistance. And I'll kind of bring it there full circle for the day. So is there room for pullbacks? Yes, of course. This market could literally drop 5, 10, 15, 20%, and it's still a bull market. Put that in perspective. That's how important it is to manage risk. Okay. Should the market pull back 5, 10, 15, 20%? Probably not. If we're going to maintain this bull market right now, and we've got fuel, we've got optimism, we have fiscal policy, monetary policy. Yeah, I get it. Like the labor market's not looking great. We've had zero data in 30 plus days. It's been difficult to make some sense of it and think like, is this reliable? Are these jobs real? ADP's printing week to week. Okay, fine. We'll see what that is. I didn't see ADP on the calendar this week. Is ADP on the calendar this week? Monday, Tuesday, I don't see ADP. Wednesday, where's my weekly ADP? I don't see it. I know they do monthly. We had ADP last week. We didn't have non-farm. CPI is tentative. I don't see ADP. Friday, PPI is tentative. I don't see ADP. So there's like third-party stuff. There's paychecks. There's ADP. There's, we just don't have the BLS, which is the Bureau of Labor Statistics. Right? So until this government shutdown is resolved, but I think that if it does get resolved, it's probably a positive sign because it's more money in the pockets of people that deserve it. Nobody wants to get laid off and nobody wants to be working without pay. So that's hopefully going to be people made whole, adding back into their 401ks and getting flows back into the system. It doesn't make the deficits look any better because all of a sudden the money the government wasn't spending this last 35 plus days is now all of a sudden going to be back spent again, but it's probably going to find its way into the markets, into the system, feeding the pig, whatever. Okay. All right. Marcus, your comment there, big gap up, market just won't stop climbing. I know, man. And this is what I'm saying. Like you can't fight these flows. This market loves to climb. And right now it is still being fueled. And I say this because the contrarian side right now, it's the market as a contrarian is going to keep pushing higher. I can, like, you don't make promises here, right? Like I know that within reason, what this market is doing more than anything else right now is if you see that the broader consensus is to be bearish, the biggest fear is a recession. The biggest fear is the worry of the market rolling over and being this crazy bear market. Until this sentiment is going to be all bullish, until this sentiment is all bullish, okay, until the bearish camp has to retreat to probably sub 30 or 25% and be way below historical averages. If the bullish sentiment increases back up towards like 45 or 50%, then I'll be a profit taker or a protective bull. That makes sense. I'll leave that with that today. Like if this right here, the bullish sentiment is going to be, let's say this is greater than 45. If this is greater than 45 on the bullish side, and this is, let's say, less than 30% on the bearish side, then I'm way more cautious because it's getting too optimistic, right? 1 year bullish highs at 50%. That was November of 2024. The market rolled over 6 to 8% during the holidays in 2024. Santa didn't show up for the rally. That was not a fun trading window. That was just like chop suey for like 6 to 8%. It went down 8%, came all the way back up, went down again, went back up, and we rolled over at that top going into February, March, and April. So it set up a pretty decent top. The market ended up dropping 20%. So that's my assessment is right now the pain trade is up. The market goes higher than you think. The market melts up, easier, faster than you think. But the nice thing is day to day, we can calculate this stuff. Okay. In my daily profit play, we do this stuff every single day. I want you to see what I put here this morning at 9 o'clock. 68.65, 68.70 potential top. Have we broken those highs? No. Right? And that's what I trade around. I don't expect my tops to be broken. I don't expect my bottoms to be broken. We talked about 68.50 today as a level that could be getting tested. It's there. I don't want to get in the way of that. If this gonna get to 50, there's little to no selling today. This could go through 50. So I'm not trying to call the top at 50. It's improbable that it goes higher than that because it's right around a 150% ATR for the day. But based on my measurement this morning between market makers and the VIX was at 18.37. The VIX is now at 17 plus. The VIX has retreated all day. Just, a little volatility here, but it's been retreating. So the point is, we tackle this stuff every single day. We know the high probabilities, tops and bottoms, right? We know it. And that's good because most of the time we don't get this stuff wrong. So if you like the idea of kind of dissecting the market day in, day out, knowing where high probability highs and lows are at, I like to be a premium seller at those levels. So because it's late in the day, it's already, after 3 o'clock, the final 50 minutes here, I'm probably not going to get filled on the trade that I want. But I do have a couple trades that are still pending for SPX. I just don't think they're going to get filled. So working order, call side is trading for, it's not going to get filled. Put side here, that's a pending for waterfall. That's for waterfall. That's for waterfall. That's it for now. So, it's a trade where I put the levels that I want. I'm patient. I put in the credits that I think are fair, and I don't force trades. I take them based on a nice system, nice probabilities. But yeah, I think the pain trade is up. And I think the crazier surprise is how ridiculous this could be. If you think this is a bubble, just wait. You have no idea what a bubble is. We're talking, do you realize that in 1998, 1999, the NASDAQ during the dot-com bubble had over 100% gains going into that bubble. You have no idea what a bubble is. Okay. And I get it. That was 30 plus years ago, or I guess, 20 plus years ago. But do not think for a second that we know where this top is at. So this went, let's just go, I'm going to go 12-month candles. Look at these monthly candles. So this goes back to 99. I wish it had more data. I probably have to go NDX, but this was up 82%. Could you imagine staring at the S&P right now up 80% for the year? I mean, it'd be the greatest thing ever until it crashes and it retraces 50% of the value, right? So it was up 80% 99. It went up again 25% into 2000 and then obviously rolled over whenever the top was and it crashed hard. So we don't know what a bubble is. This bubble's, I mean, the market's up 35 to 40% off the April lows. The market's up in the teens right now. We're up 15, 60% for the year for the S&P, 17, 18 for the NASDAQ. This isn't a bubble, but it's overvalued. I get it. There's some levels I think are pretty interesting. We're at 68.40. This market it likes it. It likes to go higher. It's being fed and fueled by a lot of things. Fiscal, monetary policy are both accommodating this market to go higher. Okay. What is the fear? Deficits to get too big, geopolitical escalations, tensions, but are earnings good? Earnings are solid. Are interest rates restrictive? No, we're reducing them. Okay. The one thing that is a concern, and I don't know how nasty it has to get, but the Fed has cut. I keep saying this, but it doesn't really matter if the market's going higher. The Fed has cut since this point here 150 basis points. Okay. So tell me how this is good when the Fed has cut 150 basis points and the yields are actually 30 basis points higher. How does that make any sense? This is what they're cutting on the short end of the curve, but it's not doing anything on the long end of the curve. This is a concern because if yields, number one, it's not just if it's a slow rate of change, it's probably not that disruptive. But when we had this and we had this, it was disruptive. When we had this, it's disruptive. This has been a pretty steady move. And if it's sideways, I mean, if it's steady, it's really not that disruptive. But if it's a really aggressive rate of change, then things get volatile quickly. But it's crazy to me that we have cut 150, about to be 175 basis points, and yet yields on the long end are not budging. So you want to buy a house, it's not any cheaper. You want to buy a car, it's not any cheaper. You want to refinance debt, you want to get out student loan, it's not any cheaper. Everything is more expensive. The cost of money, the cost of borrow, the cost of refi, it's all more expensive. That is a concern, as we are a world that cannot get out of debt. We're a world that doesn't pay off debt. We just re-leverage debt. We reload debt. We restructure debt. So eventually a crash of some sort, a cleanse of some sort is probably going to be tied to the credit markets. And right now, credit markets are still pretty tight. So anyway, that's my PSA for the day. Look out for this stuff because that in the background does mean something eventually. But I just can't call the top when this is fueled by so many things. It can climb the wall of worry, and sentiment is wrong, and the market loves to just push and push and push and make you feel uncomfortable. So I think that the bubble, you think this is a bubble, wait till we're up another 500 points. Wait till the look of the market looks something like this. Okay, if this market wants to absolutely, blow this off, let's say this is a broadening pattern that I was highlighting, and this market breaks and goes higher. Now we're talking, that's a bubble to me. That type of price appreciation is like what gold did when we ran from 3,000 to 4,000 plus, and it comes back. That will be be prepared for a nasty correction. And that correction might obviously pop a lot. But until then, I think right now we're about to enter into holiday windows. As long as the market can stabilize in here, it's probably just this. If it's slow and steady, no disruption. We break this structure, there's cause for concern, right? There's cause for concern. But if we look at the technicals and the macro still points bullish, path of least resistance is focus on the technicals. Price isn't telling us to get out. Price isn't telling us to be bearish. Risk management. Don't over leverage, right? Have some dry powder. Those opportunities pay off huge gains when you have the opportunity to do it. The reason I am up, this year is as solid as I am is because of this pullback. Okay. I have not taken tons and tons of profits in this melt up from, August, September, October. This market is, it's like, this is not where I make a lot of my money. Okay. My money is made by income trading actively. And when the market offers this, that's the reflexive that gets me, my 25, 30+% gains. Like that's what allowed me to get year to date 30+% for the year. A lot of it was when it was really crazy and terrible, but that was pretty good. So anyway, all right, couple questions here. What do we have? Terry says, how many waterfalls do you have open at a time? Right now, I think I'm in about 8 or 9 trades right now, Terry, at any given time. So I think I have eight or 9 open. We talked about that today in class. They're all defined risk. So one today, one last week, pending orders. That'd be 3, 4, 5, 6, 7. Yeah, I'm counting 8 open positions. 9 open positions. 9. I have 9 open. And there's some risk. But even though most of them are sitting with a probability of profit of like 90+%. So I'm playing the edge. I'm playing the probability that we stay profitable. So I've got 9 open. Likely going to see a lot of those are stacked up to the end of the year. And hopefully if the market just stabilizes into the end of the year, then we've got profits on all those trades. And that would be a nice little way to make. So we're at 102 winners right now. We get to like 110, 111. That'd be a great way to finish out the year. Okay. All right. I'll let you go. Thanks, Kane, for being with me. Just kidding. I know Kane was busy today. Does that help, Mark? Does that help, Terry? Good stuff. Hopefully everyone was able to, see Kane this week or jump into JD's session over the weekend. I know we did one Sunday and Monday. So anyway, all good. But thanks for joining me today for the GAM report. I'll use this as kind of my final hour segment as well. So I'm going to wrap it up here. And tomorrow, I'll get this out there. Tomorrow, daily profit play. This is a free session for everybody. If you want to join me Monday through Friday, 9 a.m. Eastern time, whether you are a member of my member services or not, this is a live trading session that you can join me. So at 9 a.m., I go live. We map out our day. I do post alerts for my daily profit play member classes. I do post alerts for double ups. I do post trades for my Project Options Edge. I post live trades for members in the service. But this is a free session for everybody. If you'd like to join me, it's 9 a.m. Eastern time, Monday through Friday. Okay. So we'll map it out again tomorrow. I'm doing a masterclass as well on waterfall income. We took a trade today. We'll teach strategy 2 tomorrow in a masterclass. Double ups. I'm looking for some good trades this week. Pinch point. We had a nice live session last week. We did, I think, another 10+ trades last week on pinch point. Crash insurance. We had a fill last week. I hedged out a 12-1 on XSP and or an 11-1. It was like an 11-1 on ES futures. So the E-mini futures for the S&P. So it cost me like less than $500 and it pays like almost $5,000. So I'm not saying I'm going to get $5,000, but the point is to have some hedging in there. I'm also long VIX into April. So if we have a VIX move, let's say the VIX gets back above 30 for whatever reason, we can turn about a $300 to $400 risk into like $3,000, $4,000 of profit with no upside cap. Like I'm synthetic on the VIX. So if we have a big fat, like 30, 40, 50 VIX for whatever reason, I'd love to get some of that ridiculous profit on the VIX. We shall see. So, all right, I'll let you go. Come back and see me tomorrow. All right, thanks, everybody. Bye.